Bengaluru, the city of gardens, the city of startups, and the beating tech heart of India. From the calm of Cubbon Park to the chaos of Koromangala, from filter coffee conversations to fintech revolutions, Bengaluru has always known how to blend culture with change. Once known as pensioners' paradise, today it's India's very own Silicon Valley, a city that's powered not just by code and capital, but by creativity, courage, and community. So, on the Money Show today, we celebrate Namma Bengaluru, its innovation, its investment spirit, and the way it's shaping India's financial future. Because your money doesn't just move, it multiplies with ideas. Just one line in Kannada, I'm just trying to say, Eli ide growthu, Eli ide Bengaluru. Now, I hope it's gone right. It just means where there is growth, there is Bengaluru. And this is exactly what we are discussing on the show today. Let's dive into the city's business pulse, from real estate to startups, from local investors to global giants, and find out what truly makes Bengaluru a class apart. I am Kavita Thapalial with you, and joining me today are two of Bengaluru's finest financial minds, experts who not only understand the city's unique pulse but also its investors' mindset. With decades of experience in guiding, hand-holding and advising people on their financial journeys, they bring deep insight into what drives Bengaluru's investment spirit. So please welcome Srikanth, Bhagavat, Managing Director at Hexagon Capital Advisors Private Limited, and Anand Rathi, co-founder of Mira Money. Hi, good evening, and welcome to the show, both of you, and a very special show, and you've taken now to participate and help us understand the investors of Bengaluru. So welcome once again, and let me begin with you, Srikanth. You know, I want to really start with understanding what truly defines Bengaluru's investor mindset. The city has such a unique mix of old wealth and new age professionals, a blend of traditional savers and modern risk takers. So, you know, what sets Bengaluru's investors apart? Srikanth.
Good evening. I think the DNA of Bangalore is really the old PSU culture and the Indian Institute of Science. Right. So it brought in the finest minds in the country already to the city. Though it might have been a few decades ago, that culture has set in, and today we are a unique city with startups, innovation, education, research, everything happening here. And you know, Bangaloreans travel all across the world. So they're exposed to so much stimulus, you know. They come in, they're willing to experiment, they're willing to look at new ideas, and most important, they are very aware. And this awareness is what sets them apart, Kavita.
Oh, that's very interesting. And I also noted the fact that you called it Bangalore. You know, this happens a lot of times from people who've lived over there, you know, even for Mumbaikars. Like I am from Mumbai. So, but for us, it's always going to be Bombay, because Bombay is an emotion. If actually it's called Mumbai. So, but yeah, I understand that thing. Anand, what do you have to say? What sets apart Bengaluru's investors?
First of all, good evening, and thank you, Kavita, for having me. What a day to talk about Bangalore, because tomorrow is Kannada Rajyotsava, and this tie signifies the color of the state. So I thought I should start with that, and wishing all of your viewers a very happy Kannada Rajyotsava. What sets Bangalore apart is the knowledge that they carry, and not just about India, but also about the globe. Primarily because there is one side of Bangalore, which is where a lot of traffic is, but that is where many of these techies work, and these people work for multinational companies, especially American companies. So what I believe is different in the city is they have a good idea not just about India in general, but also about how America and many of the other countries in the world perform, work, and then they bring the best practices out from those cities and the countries and try to implement that as much as possible in this city. So this is one of the trends which I've seen, having lived in a couple of other cities, which sets Bengaluru clearly apart from many other cities.
Interesting. Let's go deeper. And Srikanth, I want to understand from you now, what kind of money rapport Bengaluru investors have now? You've been dealing with so many investors since last so many years now. What's the sense that you get? How do they understand money?
Very interesting question. So Bangalore is like a hybrid in between
Okay.
Delhi and Chennai. Okay,
Interesting.
so
Okay.
you have Chennai at the conservative end and Mumbai or Delhi at the aggressive end. And I think Bangalore sits in a balanced manner right here in the middle. So it has evolved from being a very conservative city to an aware, aggressive ability to take risk city. That is what I like about Bangalore. And you see, much of the wealth here, as I said earlier, it's a knowledge economy. And most of the people who have generated wealth here, the new wealth, they've come from middle class backgrounds. So their money quotient is very high. Their upbringing has ensured that they've always valued money sufficiently well. So they are not somebody who want to throw away or take unnecessary risks largely, and they value the money. They're not overspenders. So this, I think, is a fantastic balance in generating new wealth, accumulating wealth, at the same time being very balanced in their risk approach.
All right. So, Anand, we can say that, so they are not conservative. So, Bengaluru has, it can't be called a conservative saver city given its history as a pensioner's paradise, Anand?
Absolutely not. It is not conservative in any means. Of course, when it comes to spending, like what Srikanth just mentioned, they are definitely a little conservative, which is a very good thing because that means they would save a lot more. But their approach has been, at least in the kind of clients portfolio that we manage, it is not conservative at all. They are always looking for growth. They have also seen that by being a little more growth oriented and a little longer term in nature, their portfolios can generate a lot higher returns. And what I've seen this city do is most of the times they are all looking for compounding. They're not someone who even bothers to worry much if the market falls, if there's a big correction. But they are always saying, okay, this money I'm going to be investing and let it compound over a period of time. They are not return seekers, but they are more of wealth generators.
Oh, that's very interesting. But then, Srikanth, I want to understand how the IT boom has actually changed the entire outlook, in making investors more open to equity and risk. Along with this, how do culture, education influence their money habits? How well do they understand equity and investing in equity?
Right. So you see, the ability to take risk primarily comes out of prosperity. So the prosperity of the driven by the IT boom, the Bangaloreans, they started earning more, much more than what they needed, much more than what they needed to spend on basics, right? So once you have a surplus in your account, you're willing to explore and you're willing to take risks. And that is how the risk culture in Bangalore has grown. So it is driven by the knowledge economy, leading to prosperity, and then an ability to take risks. Okay. And at the same time, the middle class upbringing helps them.
Interesting.
With
Okay,
most of
so
the, yeah.
sure. Go on. Yeah.
So when we look at the nature of portfolios in general and an average at Hexagon, we see that most of them are tilting towards a 65% equity kind of a approach, which is a moderate aggressive kind of an approach.
All right. So I have a lot of questions for you to understand Bangalore and Bangalore investors better. But then we also have our viewer queries on the show. So let's begin with that. And I'll come to you first, Anand. This question is from Anande Chakraborty from Gunjur Palya, Bangalore. She says that she is 25 years old, techie, and recently started investing in mutual funds. She can invest up to 20,000 per month. Also, currently, she is doing direct investment in stocks up to 10,000. Now, she's confused between investing in stocks or mutual funds. So how should she allocate her equity exposure in direct stocks and in mutual funds?
Very happy that she started investing right at the age of 24. I mean, this is excellent. And this is what the spirit of Bangalore is. We understand investing early. And considering the fact that she's just 24 and she's been investing regularly in mutual funds and stocks, I would want to look at her timeline, the way of approaching equity research, because unlike mutual funds where you can buy and hold on for a longer period of time, equity requires a lot of research before and after investing. So if she has the right set of resources to invest into stocks, I think she should pretty well continue to invest 10,000 rupees regularly in stocks. And for the remaining 20,000 rupees that she is, okay to invest in mutual funds, I would take a slightly more aggressive approach. I would want her to invest in, let's say, a Nippon small cap fund, which is slightly more aggressive, and add that with a slightly conservative or a moderate risk, flexi cap fund like a Parag Parikh flexi cap fund. So she could actually split her money between these two funds equally. This will give her the stability and also give her slightly a higher growth when the market picks up.
All right, but Srikanth, just to add more on this, definitely you can decide whether you want to go aggressive in mutual funds or direct stocks, depending on your equity appetite and your risk appetite as well. But then now, since Anand, you've mentioned one Parag Parikh flexi cap, which is a flexi cap, largely dominated in the large cap category, and a small cap. Srikanth, do you think she should also be looking at going on with a passive approach? Since if she's someone who doesn't understand markets really well, can a passive large cap be a good start?
See, so this is where the contradiction comes in. Okay. If she doesn't understand markets as well, then she should not be looking at stocks at all. And she should be looking at a professionally managed portfolio as one gets in a mutual fund. And anyway, in the case of India, we have seen that active fund managers have been doing pretty well. And even the 1% alpha that one can get, and if you compound that over, 10 years and 20 years, it can be a meaningful sum. Okay. So I do think active funds are a good thing for her to be in. And stocks only if she is very confident of the research that she's doing. So I would recommend to her that she build an emergency corpus first. Okay. At least a 6 months or 12 months worth of expenses in a low risk portfolio like bond funds or liquid funds or bank deposits. And the rest of it, she can go ahead and continue to invest in equity or equity funds.
But how can she make an emergency fund in bank deposits? I mean, she'll have to break it. What if she needs the money in 24 hours?
Yes. So bank deposits are fairly easily accessible today. Okay. Even if you go into a liquid fund, it takes a day to get the money into your account. Instead of adding a direct bank
deposit.
Pardon?
Can she do a sweep FD instead of adding a bank deposit?
Yes. Yes. She can do a sweep FD. Definitely. Okay. That's a good suggestion.
Let's move on, and I would again, want to know more about Bangalore, since you both of them are from there and you've lived there all your life so far. I just want to know about your best memories in Bangalore, because now whenever I just know a few people, few personal connections from Bangalore, and they often talk about having one old Bangalore and one new Bangalore. Srikanth, is it something that even you relate to, and you like the vibe of old Bangalore more than the new, which is more crowded and full of jam all the time?
Oh, yes, there is an old Bangalore and there's a new Bangalore.
Okay.
You see, I moved into Bangalore in 1979.
Okay.
And those were the days when we really did not need a ceiling fan. And doesn't matter which part of the year, we always went out with a jacket. And you would see people walking around with a hat or a cap on the streets all the time. And even later, I miss the trees.
Okay.
We used to have far more trees. And any street we walked in had a canopy of trees above. Now we look up, we see a metro rail.
Oh, wow.
So,
wow, that's lovely. That's lovely. Anand, what would you like to talk about as far as Bangalore is concerned? A lot of people now are talking a lot about Kannada cinema. I think the movie Kantara has really brought it to a spotlight. I think Rishabh Shetty, if I'm taking the name right, that's really talked about. So that's taken center stage. What else in terms of culture and history that you like about Bangalore?
So I moved in from a very hot place called Shivakasi in Tamil Nadu. So for me, Bangalore was like a hill station. And I moved in 2004.
Oh,
yeah. So for me, the real reason why I came to Bangalore, like for a lot of people, was the weather and the culture. And this was way back in 2004.
Okay.
And what sets apart the city is the people are very, very accommodating. I mean, I have not seen anyone welcoming people like the way they used to do, or even today they do with, the other city or other country. or other state residents. So that was very welcoming. I could adjust to the city very quickly, easily, because there was no chusha about you cannot do this, you cannot do that, and this is how the city. And the best part about at least having lived here for about 21 years is that if you're in your, I mean, I am in the place where there are a lot more traffic jams. I'm not like Srikanth. He lives in slightly older Bangalore, and I live slightly in the newer Bangalore side. If you're in your apartment complex, this city is the best to have. The only thing is, if you want to step out, you need to be very careful. So you're good in your apartment, you're good in your surroundings because the
Right.
weather is amazing, people are great, very, very warm people, good culture. But the real problem starts once you start hitting the road.
Oh, that's interesting. Now that's a taste of the now Bangalore that we are getting from you guys. All right, but then Srikanth, let's move on and let's take Shweta Hebar's question from HSR Layout Bangalore. And she says that she has recently made a mutual fund portfolio of 45 lakhs and she's about to retire in another 5 to 7 years. Should she be considering an SWP? Now that's very interesting, but I have no idea as to what's the amount for which she needs an SWP. She still has this 5 to 7 years, but the portfolio is invested exactly where? Because if it's an SWP, you really need to shift this money into a safer investment option also. And we also need to know the amount exactly, what's the SWP amount that she needs every month. But lack of details out here, how would you help her out?
Yes, but we do have a situation and we have a broad idea, correct?
Right.
So I would say the SWP is the best way to go forward if one needs a withdrawal from the portfolio. You see, after one retires, you're looking for a steady income. You just like salary would hit the account the first week of every month. The systematic withdrawal plan can ensure that a certain fixed amount hits your bank account every month. And so the SWP maintains a discipline and regularity. So that way the SWP is a great way to do it. But what I would recommend and caution her is like this. When you're in a retirement corpus mode, you need a less volatile portfolio, which means that you need to have more debt and less equity. So ideally, if you are in a kind of a 30% equity, 70% debt mode, volatility is low and you're still beating inflation with a 30-70 kind of a split. So that is what I would recommend her to do before she initiates the SWP. And then, of course, there is the thing also, how much money should she be able to withdraw? Since we don't have specifics, let me put some guardrails about it. There's a concept called safe withdrawal rate. A safe withdrawal rate means what is the maximum that one should be withdrawing every year from the portfolio, and at the same time ensuring longevity of the portfolio. It should be able to last for 25, 30 years or more. So this, out of research, we find that it's anywhere around 2.5 to 3.5% withdrawal on the initial corpus. And then you can adjust it for inflation every year.
Okay, sure. Anything else, Anand, you want to add? Yeah, Srikanth, you're saying something? Yeah. Sorry.
So I think one way of getting a lower volatility in the portfolio without too much hassle for a lay investor is to introduce balanced advantage funds into the portfolio. So these are funds that can keep the volatility low and make the withdrawal simpler without rebalancing being the burden of the investor.
All right. Conservative hybrid can be good for them. But then Anand, what's your recommendation? Anything to add?
So because she's expected to retire after 5 to 7 years, I would want her to take different paths towards retirement. The initial 3-4 years, she could be a little more aggressive. When I mean aggressive, she could, as per her risk profile, because the aim should be to maximize the corpus as much as she wants to or can, at least for about 3 to 4 year period. And once she is clear about her retirement date and age, maybe she can take a call of moving money, as what Srikanth was saying, into slightly more conservative options, and then split the money into 3 different corpuses. I have a slightly different take on this, wherein, let's say today is the day she retires, she can split her money into, let's say, 20% equity fund still, about 30% into an equity savings kind of a fund, and the remaining 50% into about safe debt funds or so. I generally want to keep about 1 year to 18 months kind of a runway, the money that she wants to withdraw in a safe liquid fund. and keep plowing the growth I would see from money from equity and equity savings fund into the same debt fund so that she can continue to last longer. And if she maintains a good rate like what Srikanth again was mentioning about 3.5 to 4%, I think she should be able to retire pretty comfortably.
All right, let's move on. And Anand, let's take Rekha Heligiri's question. This is from Kadugodi, Bangalore. And she says that she wants to start an SIP for 1-year-old baby, and what kind of funds should she be investing in?
Again, happy that she's starting very early for a 1-year-old baby, and assuming that she's saving this for his or her education, or maybe at a later point in time higher education, where the time frame to invest and hold the money is for a longer period of time, in this case 17 18 years. I would want her to split her money into two different options. One is where she will take an exposure into all asset classes that are possibly available, which is equity, debt, and let's say commodities. That is one, which is called a multi-asset fund. She could possibly choose from Nippon Multi-Asset Fund or an ICICI Multi-Asset Fund to invest. And the second approach that I would want to do is where she can be a little more aggressive and invest her money into equity, but have good amount of equity allocation into each of the market caps, which is large caps, mid caps, and small caps, for which I would suggest her to invest into a multi-cap fund. In this case, she could possibly invest into an Aditya Birla multi-cap fund or a Mirae multi-cap fund. So I would split her money into 50-50%, 50% into a multi-asset fund, and the remaining 50% into a multi-cap fund.
All right. Srikanth, your advice?
Yes, I think what Anand says is very good. When I started the SIP for my elder son, he was already, I think, about 5 years old. But I went into a FlexiCap equity fund, and it wasn't called FlexiCap in those days, but it turned out to be a FlexiCap. Like it was the HDFC equity fund. And all that I wanted, I put into it because I knew this was for the long term. And I did not include any debt in this. Since it was like a 20-year perspective, I only kept on increasing the SIP. And I would advise that regardless of what happens to the market in between, not to stop the SIP into the equity funds. Let it go on. It's only then that only when one endures through the market cycles that you end up making a lot of wealth. The compounding really kicks in. And I only withdrew the fund when he needed it for his engineering. I allowed it to compound all those years, and it was a fabulous return. I did not need to dip into my bank at all for his education. So that is what a long-term equity SIP can do.
Mm-hmm. Absolutely. So very important to take the right step at the right time. But then you know what? My time is up for the show today. I think next time we'll have to do like an hour session whenever we are doing the city special. So actually it's a wrap now on the Bengaluru special of the Money Show. Thank you so much, Anand and Srikanth. So Bengaluru, from being a pensioner's paradise to becoming India's startup and investment powerhouse, Bangalore truly shows how tradition technology can work hand in hand. The city's investors are disciplined, informed, and forward-looking. Proof that smart money doesn't sleep, it simply compounds. Thank you so much for watching The Money Show today, and keep sending us your questions. Goodbye.